All right, today we're going to decode a language that isn't spoken in words, but in charts. We're talking about technical analysis, this kind of art, kind of science of trying to predict the future just by reading the history written in a stock's price. I mean, it's the million-dollar question, right? Can you actually predict where the market is going to go next? Well, for a certain group of folks, the answer isn't buried in some dusty company report or the latest economic news. Nope, they believe it's written right here, in all those squiggles and lines on a price chart. The whole idea is that every single piece of information you could possibly need is already captured in that price history. So let's dive in and see what that's all about.
Okay, so what is this thing, really? At its absolute core, it boils down to just one thing: the price.
So, to put it simply, technical analysis is basically the study of market action. You're looking at past prices, you're looking at volume, and you're trying to forecast where things are headed. And the huge central assumption here is that everything, and I mean everything from earnings reports to big news headlines, it's all already baked into the price you see on your screen right now. Now, this is where it gets really interesting, because you see how different it is from what most people think of, which is fundamental analysis. With fundamental analysis, someone's digging through balance sheets, P&L accounts, trying to figure out what a company is really worth. A technical analyst, they just look at all that and say, nope, forget it. The only thing that matters is what the price is doing right this second. So to really buy into this whole approach, you kind of have to accept three big ideas. Think of them as the pillars that hold this entire philosophy up. Okay, first up, the market discounts everything. What does that mean? It means any piece of news, any earnings surprise, any big political event, boom, it's instantly reflected in the price. Second, prices move in trends. The idea is simple. A stock that's going up tends to keep going up, and one that's going down, well, you get the idea. And third, and this one's a biggie, history repeats itself. This is all about human psychology. The belief is that people, as a group, tend to react to similar market situations in the same predictable ways over and over again, and that creates patterns you can see on a chart. All right, so based on those three core assumptions, a couple of major theories have popped up over the years that really form the foundation of technical analysis today. Let's take a look at two of the heavy hitters. First, we've got the granddaddy of them all, Dow theory. And yeah, it was developed by that Dow, Charles Dow, the guy who co-founded the Wall Street Journal. See, he was watching the big stock indexes of his time, what he called the industrials and the railroads, and he came up with this really revolutionary idea. He said the market isn't just a random mess, it actually moves with purpose. It moves in trends that you can actually spot and follow. And Dow, he broke these trends down into three main types. The best way to think about it is like the ocean. You've got the primary trend, that's the main tide, the huge multi-year bull or bear market. Then you have the secondary trend, which are like the waves on top of that tide. These are the corrections that go against the main direction for a while. And the minor trend, that's just the little ripples, the day-to-day noise. This chart really shows you what he was talking about. You can see that big primary upward trend, right? But look closer, it's not a straight line up. It's broken up by these smaller secondary movements, these little pullbacks before it continues on its way. What was really key for Dow was that a real trend was only confirmed when both the industrials and what we now call the transports were moving together. That was his signal that the whole economy was in on it. So for an analyst, the whole game is figuring out if you're looking at a wave or the whole tide. Okay, so building on what Dow started, this other guy came along in the 1930s, Ralph Nelson Elliott, and he tried to get even more specific. He looked at those trends and said, you know what, I think the crowd psychology that drives these moves isn't just random. I think it moves in really specific repetitive patterns he called waves. And here it is, the classic pattern. Elliott's big idea was that any major trend basically has this 5 steps forward, 3 steps back kind of rhythm. You get 5 waves pushing the market up in the main direction, and then you get a 3-wave correction pulling it back down. So analysts who follow this theory, they basically spend all their time trying to figure out exactly where we are in this big 8-step dance. So you have these big theories, right? Dow, Elliott. But how does an analyst actually use them? Well, it all comes down to the tools they have in their toolkit. For a technical analyst, the chart is literally everything. It's their entire world. They see it as this canvas where the epic battle between buyers and sellers, supply and demand, is playing out in real time. And their whole job is to read that story and try to find patterns that give them a clue about what's going to happen next. And two of the most basic but absolutely crucial ideas are support and resistance. Think of support as a floor. It's a price level where buyers just seem to show up and say, nope,
not going any lower, and they start buying. Resistance is the opposite. It's the ceiling. It's a price where sellers take control and stop the price from going any higher. On top of that, analysts use all sorts of indicators, like a moving average, which is just a smoothed out version of the price. It can act like a moving floor or ceiling that follows the trend.
And there are tons of different ways to actually look at this data. I mean, on the left, you've got your standard bar chart, pretty common. It shows you the open, high, low, and close price for a specific time. But then on the right, you have something a little more out there. It's a point and figure chart. It completely ignores time and just plots big price moves with a series of X's and O's.
But, just chasing the price with these tools can lead you down a very interesting rabbit hole, psychologically speaking. And there's a really sharp critique of this whole approach that's summed up perfectly by one fantastic theory. You have to love this diagram. Right there, in the middle of doing something dumb and hoping someone else is dumber, you find the greater fool theory. And this really is the big knock against relying only on price. The greater fool's theory basically says that sometimes prices don't go up for any good reason at all. They go up simply because people are buying something they know is overvalued, because they believe they'll always be able to find someone else, a greater fool, who's willing to pay an even higher price for it. This is a huge warning sign for anyone who gets too focused on just price momentum. It perfectly explains the danger of speculative bubbles, those times when prices just completely detach from any real value. It's all just based on the hope that the music never stops and there's always another buyer coming to the party. But here's the funny thing. Whether you're a true believer in chart patterns or you think it's all just about the greater fool, you kind of end up at the same conclusion. Both sides have to admit that markets are powerfully driven by human emotions. Fear, greed, hope, the whole shebang. The only real argument is about how predictable those emotions actually are. Which kind of leaves us with one last big question. Is all this chart decoding a real reliable science for predicting what's next? Or is it maybe more of an art form, a way of making sense of the psychology of the past and just hoping that history rhymes in the future? Well, that's a debate that is definitely not over.